Alright, so I'm Jeff here back again with another video. So today I will be talking about the option strategy that I'm actually adapting for this current volatile market that we do have. Because let's not forget, we do have the whole Russian-Ukraine tension that's currently going on. We also have the Federal Reserve currently thinking about going through 5 to even 7 rate hikes, with Bullard thinking that 1% by July 2020 is also a thing. And let's not forget that we have a lot of inflation currently in the market as well. So today, I'll be explaining my option strategy. And before I actually begin, I do want to say this one more time. I really want to emphasize this. This is not financial advice, and this is very important for me to explain. Because in terms of options is a very dangerous strategy to begin with. You can easily lose money. You can easily get margin called for option. So do not do this if you do not know what you're doing. I'm only explaining how I'm doing the options for my own portfolio. It might not work for yours. So this is just purely from a speculative point of view. So do not follow what I do, okay? All right, anyway, I'm just going to show you guys a blank sheet of paper. For example, if I do want to do any sort of option. So for example, let's just take Apple, for example, okay? So for Apple at the moment, Apple is about $166. So right now, if I were to look at Apple, okay, and personally, I do have Apple stocks as well. Currently, I own a total of 150 stocks in Apple, okay? So personally, what I did with Apple was that with the 150 stocks in Apple at the moment, that I just split them up to 100 shares and 50 shares. So these 50 shares, I do not touch them at all because I cannot do any sort of option strategy around it. So I only work with this 100 shares that I do have. So currently, we see that Apple is at $166, okay? So what I would do is I would look at $170, $180, and $190 call options for me to actually get for the worth of Apple. So right now, if I'm going to be looking at Apple, the options for Apple at the moment for a call, let's look at call for Apple. All right, if I am going to be doing a far out call for Apple, let's call it by May of 2022. Let's do Apple at 190, okay? 190 at the moment per contract, you will be getting $2.16 per contract, which means that this would be $216 per call, essentially. Okay, so what I'm going to be doing here is that I am going to be selling a call contract. So aka with these 150 shares that I do own in Apple, okay, I'll first be getting a $216 premium, okay, and this will expire on the 20th of May 2022. Okay, so what this actually means is that I'm only promising myself that if Apple goes up all the way to $190, I don't care. If Apple goes to zero, I don't care. Because what happens here is I am now giving the chance to sell 100 shares at $190 per share. Okay, so when you sell a call option, basically you are bearish on the position. Okay, selling a call means you're bearish, selling a put means you are bullish. Okay, so when I sell this one call, okay, because one call would be going with 100 shares. Okay, so when I sell this one call, I get $216 in premium. Basically, me just getting this money, it will most likely be free, because for me to see if Apple will hit $190 by 20th of May 2020, which will be coming in exactly 5 months' time, I don't think that would happen so easily, which is why I think that this is a very valid strategy for me to apply to. And of course, with the $50, the 50 shares left in Apple, okay, I just do not touch, no touch. You don't touch those shares, okay? So what happened here is that if I have 150 shares now, right now, the 100 shares is now being locked up as collateral, okay? It's now going to be locked up for collateral. And because the thing is that if 100 shares are going to be locked up for collateral, you writing this contract for $190 per share is almost risk-free. Of course, again, I do want to say, when I do say risk-free, it simply means that, I'm expecting Apple to not suddenly have shoot up in price all the way to $200 or $300. And even if Apple were to shoot all the way up to $200, do you care? Because let's not forget, you will only have two different endpoints, okay? Apple go to 0 or Apple go to, let's say, $500, okay? We are now in this sort of spectrum, okay? And maybe over here we sell the call, okay? The whole point of this option strategy, we want to get anywhere from here to here. This would be the best point, because let me see if I can get a color up in here. Okay, so over here to here, this is our favorite area to play with. If Apple stays anywhere within this area, we earn the money, because this $216 is going to expire worthless. So when it expires worthless, it will become $0, and you will automatically earn the $216 for free, basically. Okay, of course, let's just say that Apple suddenly have like multiple good news. We got Apple car coming out, you suddenly got Apple robots, you suddenly Apple just like buy over Microsoft or whatever it is. Okay, there is the possibility that Apple might end up here or end up here, whatever it is. So you do need to know that when you have this selling of call over here, even if it reaches to, I don't know, over here, let's say $260, you are still selling at $190. So that's the issue here. Okay, so of course, you don't want to be holding on to these sold calls if Apple do go up all the way until here. Okay, if we do see any sort of that kind of movement over here, you want to buy back into the call so you can cut your losses if that were to happen. Okay, and if you don't see that happening, I don't care. I'm just going to keep on to it. Okay, so now the question will be, when are you going to buy? No, not buy. When are you going to sell call options? Okay, we do not know when is the good time for us to actually sell the call options. So I'm going to give you guys how it actually works out in graph kind of form. Okay, there's going to just be two sort of graphs. Okay, if the graph go like this or the graph go like this, you want to be selling your call in this sort of scenario, in the A scenario. In the B scenario is the best time for you to sell put, sell call. Okay, so the reason why you want to sell a call when the market is going up. So basically, when the market is going up, it means that, for example, if Apple suddenly intraday went up by 4% or 5%, something ridiculous, you want to be selling call, because usually it's always met up with people who suddenly want to take profit, people who want to sell out of the market, or of course, for future even worse bearish catalysts to come about, people want to sell off, and the market and the price of the stock would eventually wants to go down, 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 down. Okay, so when the market is going up, what you will want to be doing is you will want to be selling the call, because that's when your call have the most amount of value. When you see huge volatility on the upside, that's when you get the most value for your call. Okay, the reason why we only took $216 is because Apple wasn't having an exactly best day yesterday. Okay, with Ukraine situation happening and also hyperinflation happening, Apple was not having a good day. Okay, and because Apple wasn't having a good day, we have to put into a perspective, which is $216. Of course, if the market is like the scenario A for, if the market, if Apple have this sort of scenario for scenario A, okay, there is a chance we might see it go to $300 or even $500. It happens a lot. Okay, I usually take my premium at about $480 or so to $600. for bigger caps such as your Apple and your Microsoft. Okay, so usually this is how I farm yield out. Okay, so this is when you want to sell the call. Okay, so now you know how I am doing my selling of my call. Okay, so let's just say Apple's miraculously, Apple miraculously hits $190, and I do not get caught up for my options as well. I get my free $216 for free. Okay, I do not get caught up at all. Okay, and then Apple starts to go up in price. Okay, of course, this would be the best case scenario for me. The best case scenario for me, because if I get the $216 for free, I still hold 150 shares of Apple. Okay, so if I still hold 150 shares of Apple after getting the $216 for free, which is my premium for selling the call, if the price of Apple continues to go up, you have two different choices to do now. One, you can sell another call for even higher, which is you can do it for $230, $250, depending on the day itself. Or you can just hold on to your shares, and maybe you want to sell a little bit of shares when it reaches $200, $210, whatever it is. You can basically just sell away your shares if you want to. Of course, I do not encourage people to sell their shares, because selling their shares not exactly the best thing that you can be doing. It's better for you to actually just hold onto your shares and do a little bit of options by the side. But of course, this strategy only works for my portfolio. I'm not sure about your own portfolio, so it might work for you, but you do need to do your own research for this. Okay, so let's say this is the good part. Okay, let's just say the worst case. Okay, the worst case scenario. Okay, basically Apple hit $191 on on 20th May 2022. If this happened, okay, well, I won't call it worst case. Okay, I will say base case. Okay, base case. This is what happened. Apple hit $191 on 20th of May. So now you do get this money premium. Okay, you do cash this out for free. Okay, but in return, you will be selling 100 shares of Apple at $190 per share. Of course, if the current price of Apple is at $191, you're only basically losing $100. But let's not forget, you losing $100 and you getting $216 of premium, you're still kind of up on your investment. Okay, so now if this happened, I'll actually explain to you what would I do for this if this happens. But let me just give you guys the worst case scenario first. Okay, the worst case, would be let's say by the 17th of May, maybe. Okay, Apple hits $220, and your current negative $2.16 contract is now going to be let's say $400. So let's say $415. Okay, so now you are gonna be down close to $200 on that option itself. And now you have to kind of think about it. Do I want to just buy back in and just realize loss for the $200? You can either realize the loss for the $200, or you can basically just be like, you know what, I don't care about this at all. I'm still gonna be getting my 216 for free, but in return you'll have to sell Apple at $190 per share, whereas Apple is at $220. Okay, so that means 220 minus 190 equal $30. Oops, $30, and that means you are essentially losing out on $3,000. So you want to lose out on $3,000, for example. Yeah, you are losing out $3,000 for you to get $216. Of course, I'm not saying that it's going to be $200 in your realized gains, because the thing is that if it's going up to 220, chances are this is gonna be more realistically gonna be at about $10 or so. So let's not care about this loss for now. But what you're gonna be doing is you want to realize this loss, or you want to just not realize this loss, continue holding on to the hope that you get back this $216, and at the same time you might be potentially losing up to this much amount of money. Potentially, of course. But yeah, this is the worst case scenario, okay? And I really don't have much for you for the worst case scenario, because usually what I do is when I look at the market, I see if I'm going towards a worst case scenario. If I see myself going to a worst case scenario, I'm gonna buy back in. Okay, I don't care if I'm gonna be realizing loss of $200, $300, $500. I'm gonna buy back in because I want to make sure that I want to hold on to the shares instead of me like going through this whole worst case scenario. Okay, but what to show you guys what the base case what the base case is gonna look like. Okay, the base case basically hitting 191, for example. So let's just say you already gotten your $216 premium, okay, for free, and you basically lost out in on this $100 additional. Okay, lost out. Okay. But remember what I said about how you should sell call when it's going up and sell put when it's going down. So basically now that you already have this additional money, okay? So basically what you're going to be having now would be you have an additional $19,000 plus $216, okay? So you have an additional 19,216. 19,216. What you're going to do is you're going to be holding on to this money, okay? You're going to be holding on to this money and not do anything. Okay, you're not going to do anything yet. Okay, and when you see Apple do this sort of motion now, okay, it don't have to be this kind of motion. Okay, it could be this kind of motion. Yeah, this kind of motion works, or it could be this kind of motion. Yeah. So usually for this kind of thing, when the best time for you to buy the put, I'm going to use it in red for you guys to see it more clearly. It's going to be here. It's going to be here. It's going to be here, 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 here. You want to sell the put, okay? You want to sell a put when it's at its low. Of course, in hindsight, I can show you this graph and all of it. Okay, it's not gonna be easy for you to be. Oh, I'm gonna plan it right here. I'm gonna plan it right here. I'm gonna plan. No, okay. Trust me, you're not getting it. Okay. What you can, however, do is that over here, maybe you can just sell a put here, or at a second time, you can possibly sell a put here. It doesn't matter. Okay. And if you truly think that this is a stock that would go up, without a doubt, it will go up. Sell put up here. Sell put up here. Who cares? Because when you're selling a put, basically you are being bullish on the stock itself. Okay, selling a put means you're being bullish. Okay, so for example, let's look at how much are puts at right now for Apple, for example. Okay, I'm gonna look at the same thing at 20th of May. Okay, I'm gonna put a put at, let's just say, 165. Okay, 165. All right, let me just open up a new one for you guys. Okay. Oops. Okay, sell put 165 per share. Okay. Currently, I'm just going to be using the current trend lines instead, simply because Apple is kind of going down anyway. So I think it's very fair for me to just kind of use it for the selling of put. The reason why I would sell a put at this period of time. Okay. So what will happen is you are basically going to be putting up $16,500 as collateral. Okay. So you'll be locking up this money. And then on top of that, you're going to get, right now, the price is $9 per contract. Okay, so $9 per contract, for example, which would also equates to $900. Okay, you're gonna lock up this much money, and you're gonna be getting this much money for free. Okay, well, not for free, because you're basically locking this amount of money up. Okay, so now that you are locking this money, this amount of money up, you are now getting $900 for free. Okay, so what happens is same thing. Let's do a best case. Okay, a best case. The best case for you is if Apple goes to $220, for example, $220. Okay, when this happens, Apple goes to $220, your put basically just stays as it is. Okay, it just stays as it is. Okay, and let's just say by the 20th of May 2022, when this hits and Apple is still at $220, okay, what will happen is 165 per share is gonna be executed. Okay, you're gonna be executed on this. Okay, and then you are going to lose. You're gonna lose your $16,500, and you're gonna be getting 100 shares of Apple. This is what you're gonna be happening. Okay, you'll be a proud owner of your 100 shares of Apple at $150, $165 per share. Okay, and on top of that, the $900 that you have, that's for you. That's your premium. You get to keep it. Okay, so now that this entire thing has been done, okay, if you want to count it, if you want to be exact about it, you're basically paying about $156 per share because you are taking into account of your $900 premium as well. Okay, so right now you have 156 per share as compared to market value Apple at $220, right? At $220. So right now what happened over here is that you are up 64. You're up $64 per share of profit, okay, which also equate to $6,400. That's the kind of thing that we call it as selling put. Of course, like I said before, okay, I'm not going to be BSing you guys. This is, of course, what I call the best case. You can bring this up to 300, 400, 500, I don't care, okay? But this is the best case. I do assume that this is the best case, okay? Now, let's talk about base case. Okay, let's talk about base case. Apple basically just trying to just stay around the pricing itself. And it actually stays at like $166, what it is right now. Okay, so what happens is you now own 100 shares of Apple at $165 per share, because right now it's at 166, for example. Oh, no, actually, no, $160. Okay, then I'll treat this as a base case, $160. Okay, but you have to own 100 shares of Apple at $165 per share. Okay, so right now technically you are down. Okay, you will be down by about $5 per share. Okay, $5 per share. You'll be down by $5 per share. But let's not forget, you did get a $900 premium when you first sold your put. Okay, so now you would be the proud owner of 100 shares at $165 per share. Okay, so now since you have 100 shares, remember what we do when we have underlying shares. Basically, when you have underlying shares, you can sell call. This is the whale strategy. Basically, you're going to be selling put, getting stocks, and you sell those calls with underlying shares that you got from those puts that you were executed on. Okay, so that's kind of the strategy I'm currently using at the moment. Okay, so with that, basically you just go back to selling your call again, of course, at the correct timing. Okay, during this sort of market, you want this sort of market, you want to sell here, you want to sell here. Okay, do not sell on this sort of market downwards. Okay, especially when it's closing to the floor price of the stock, do not sell a call. Okay, this is very, very important. Of course, but you know, I don't want to be a financial advisor for that part because you know, I'll never know how it goes. But I do want to show you guys what is the worst case scenario. Okay, the worst case. Worst case. Okay, before I get too excited about it, Apple basically dropped to $50. This can happen. Okay, this can happen. I don't want to be this positive guy who is gonna tell you that, you know, Apple is going to the moon forever and ever and ever. You know, Apple is always gonna be innovative. Apple is gonna be relevant. Apple is always gonna be coming out with the best iPhone, the best phone that's gonna be in the entire industry. Apple is gonna monopolize everything. I'm not gonna be that guy because I don't think Apple can withstand being the best forever. Okay, for a long time, yes, but not forever. Okay. So Apple at $50, for example, if that does happen, of course, by May 2022, very, very unlikely, but I'm still gonna be putting it at like at $50 just to give you guys the context of it. You're still gonna be buying at $165 per share. Okay, and chances are this put that you're getting of $9 is possibly gonna be worth $50 per put, aka $5,000. Okay, and you might want to realize these gains instead. Instead of you wanting to buy Apple at $165 per share, and this can happen. This can happen. Okay, and this happened to me a lot as well. I'm not gonna lie to you guys because this happened to me a lot. This happened to me on Peloton. This happened to me on Affirm. This happened to me on Unity. And yeah, you know, this kind of thing can happen, which is why I think that it's very, very dangerous for people to think that options is so easy for you to get into. Options can be very, very, very dangerous as well. And of course, if you're doing a whale strategy, it's better for you to actually cut a little bit of losses. Okay, for example, at the start, I was thinking that I want to get $9,000 per 2 months. Okay, if I were to do it with my own strategies, $9,000 per 2 months, which equates to about 4,500 per month. But I'm going to cycle on a 2 months period for my whale strategy. And what I did realize is that instead of me going for 9,000 for 2 months, I can actually drop it down to 7,000 per 2 months to make it a lot more safer for myself. Okay, the loss of $2,000 increases my security for all my options trade. Okay, of course, recently with this sort of volatile market, even 7,000 per 2 months might not be that easy. So I'm actually bringing it down to about 4,000 per 2 months. So of course, I'm bringing it down to about $2,000 a month. But the chances of me getting executed on this sort of this level of options trading is very, very low, and I can get this a lot easier. Okay, I'm not gonna get executed as much. Chances I'm not gonna get called as much. I'm not gonna get margin called at all because I have all the underlying cash and the underlying stock for all these sort of trades. But yeah, that's my strategy for doing options in this sort of volatile market. And let's not forget, I actually explained it to you guys before that we are going to be in this volatile market for quite some time. Okay, like don't expect this to be like a market that we will suddenly just get out of in the very, very near future, because I don't think that's what's going to be happening either. I think that this current market is going to be very, very dangerous. Especially, let's not forget as well that there's not enough good news that's being lined up at the moment, but we have a lot of bad news that's being lined up, and that's going to be the worry that we do have. Okay, I don't see a lot of good news up ahead, which is why even at the start of the year I did say that a lot of stocks is going to be trending sideways, eventually going downwards. Because at the start of the year, I did not see any sort of bullish catalyst. I did not see that the economy is going to be opening up completely. I did not see cyclicals coming back completely. I did not see businesses recovering so much to the point where I think that there's some form of euphoria in the market either. And that's kind of the situation at the moment. So right now, what I'm doing is basically trying to play options safely. Of course, I do have my own speculative side of things where I just speculate on any sort of shares going up to the moon. Of course, I do hope that those happens very, very often, but it doesn't seem to happen that often. I do buy calls and buy puts as well, but those are very, very speculative bets. And of course, those are also the one that's losing me a lot of money. So when I did explain to you guys that I'm earning $4,000 a month, on the other side, I'm actually spending $3,000, $5,000 a month trying to speculate on the point where, like, if Ford is going to go to zero, or if Peloton is going to go to zero, or if Palantir is going to $20. Okay, I do have a lot of speculative bets by the side, and because of that, that's the reason why you can lose money. But I think that it is a lot better for me to earn a little bit of premium on this side and speculate on the other side. That way, I think I can have a bigger form of way for me to actually earn more money in the long run, as compared to me just basically just speculating all the time without getting any form of a safer premium return. And then if I keep on doing this speculative bets on the side, I'm gonna just lose all my money completely. And just to let you guys know, my portfolio did diminish quite substantially. Especially since crypto is down. Of course, crypto doesn't really take that big of a portfolio does not take that big of a pie chart in my portfolio as it is. But stocks, especially, I am very, very invested in like the smaller cap stocks, and the smaller cap stocks basically just got destroyed. Just look at Cathy Wood, and you will see that basically Cathy Wood, every stock that is under Cathy Wood got destroyed from the November, December, and January period of time. And that's kind of the trend for a lot of stocks in general. Even for Apple, trying to really go all the way up, couldn't even withstand staying in the $3 trillion bracket for too long, and then it just kind of faltered back down. Microsoft went down. And let's not forget, talk about the FANG before, your Facebook, Amazon, Apple, Netflix, and Google. All of them basically are not really doing that well. Google right now is at $2,600. Okay, this is the price before they actually released their earnings report, which announced that they are doing a 20-to-1 split. A 20-to-1 split for Google should easily announce to the world that Google is easily going to go to $3,000 or $3,200. Easily. And Google is at 2006 now. Like sometimes I just think about it, I'm like, really? Google at 2006 now? Which is why this market is very, very whack at the moment. And yeah, it's going to be tough for people to really invest in this. Which is why I did want to share my option strategy with you guys. Because that's basically where I'm getting my side income for me to actually do so many speculative bet on the side. Because I'm pretty sure that some of you are probably thinking like, how am I still continuously doing speculative bet on the side? It's because of a safer option strategy that I'm actually currently adapting at the moment. But anyway, thank you guys for watching. I do have some links below if you want to invest with Moomoo. I do have a link below. Of course, if you're not into crypto trading at the moment, okay, you can use my link down below using my Gemini code or my Coinbase code. Of course, I do hope that you guys use the Gemini code, as the Gemini one would work better for Singapore accounts. For the Coinbase one would work better outside of Singapore. But anyway, I thank you guys for watching. And I'll see you guys next week. Monday is going to be Washington Day, so I will not be posting any videos. But on Tuesday, I'll be back with the news again. I thank you guys for watching. I'll see you guys.